Hello guys, I have some money to invest, but I currently don't know how and where to invest it. I have a friends for you to read. Could you please read this? This is very interesting book by the Jim Roger, and get back to me in the 2 weeks so we can discuss what is the best option for me. And I think this is the time is sufficient for you. Okay, you ready? Yes, good. Okay, see you in the 2 weeks. Bye. Okay. Good evening, everybody.
Good evening.
How are you? Fine?
Fine.
Okay, very good. Have you read from this book last 2 weeks?
Yeah, ready.
Okay, nice. So let's start to discuss for this book. Are you ready?
Ready.
Who want to first?
Okay, Pak. I would like to start first.
Okay, please.
So basically, after I read the book, there are several options of investment in this case.
Okay.
The first is stock, but the thing is, currently most equity are overpriced on historic basis. So it will be difficult for you to get income from the stock. The second one is the bonds, but the thing is, most of them having a very low interest through the decade, so it will not make you rich. Real estate is a good investment, but currently those are already too expensive, so you will not get any payback for that. And the currency, I think you can explore this, but it will be quite risky for you. And then some government is actually playing a monopoly for their currency. So we recommend you to invest on commodity.
Okay, this is the choice for the always my
Yeah,
investment.
we recommend you to invest on commodity.
What is the commodities and why I should choose for these commodities?
A commodity, which are raw materials, natural resources, hard assets, and real things, are essentials to the life of everyone. We are currently surrounded by commodities in our life. Without the commodities, the future market to set and regulate the price, the things we need will be overpriced and also scarce. Okay, and the example of the commodities itself is like oil, gas, wheat, corn, cotton, soybeans, aluminium, copper, lumber, and everything that's around us actually.
I want to add something, Pak.
Okay, please.
So basically, some people said that commodity is very risky since there is not much expert who is having the experience for commodities trading as well as the license for that. It is not certain as well, but it is proven that when the stock is falling, most commodity are actually rising or booming. So there is a negative correlation between stock and commodity. And as you know that most Asian countries currently dramatically growth over the past 25 years. And then ironically, most people are focusing on stock trading starting 1990s. So it is a huge opportunity for you to invest back.
Okay, please explain a little bit detail for these commodities.
The first one is oil. Actually, there's no major oil field that has been discovered for more than 35 years. Most of the giant reservoir has been 50 until 70 years old. And no new refinery were built during this time. And the second one is natural gas. Production in America is not in pace with the demand and new deposits found, but the cost of exploration will be more expensive due to the depth of the deposit. And also we have metals. No new mine opened in the last 20 years also. And the last is sugar. It is because lack of sugar plantation, sugar has become an energy source as well, converted into ethanol. It is currently in low supply and increasing demand also.
And the other thing about commodity is the nation economic health, it's not a deciding factor for commodity. Because no matter how badly the economy is, the necessity of life and basic means for jumpstarting the economy is still required, and it sustains high demand for commodity. So the commodity futures are positively correlated with the inflation. The higher the inflation is, the higher as the commodity future is. And then war and political chaos is not really reducing the price of commodity, but it even make it higher. There will be a setback and the risk. So there are several things that you need to understand as well.
But wait, Pak, commodity is something new for us. So I think I can see there is a risk before entering the commodity market. So I'm suggesting that we have to do a preliminary research before entering the commodity market. I think we have to understand the first one is the trend and also the demand and supply. That's probably I would like to suggest that we use a CRB. That's one of the things that we can use for the review before entering the market. What do you think, Pak?
Okay, you means there is the risk. So what advantage for me?
So you can take advantage of a growing demand. So how do you take advantage? First, you can buy shares of companies that produce in commodities. However, sometimes the stock price has little things to do with the actual performance of the company, because there's a lot of external factors that takes into account, such as government policies and also management. Second, you can invest in countries that produce commodities. However, there are internal threats that are way less predictable. And third, you can invest in real estate, also countries that are rich in commodities. And fourth, you can buy commodities, and we consider this as the best form because we can manage our own trades or we can use trading services. However, there are many options for this. The options are you can open an individual account or you can also open a managed account, and also a trading futures option and many others.
Okay, so Pak, we are suggesting to buy commodities directly. But step into the commodities, we have to understand the concept itself, which is a balance between the demand and the supply. And we have to be aware with the two things before entering the commodity. The first one is because the commodity is unregulated in the market. And the second one, we might be deal with something unpredictable. For example, the strikes, bad weather, like that. And I have to say that the trading commodities is like a trading of future or contracts. So we have to take a look at four standard, the quantity, description, the delivery date, and also the payment terms.
Okay, so for the futures of commodity price itself, it's a fixed price. But the price of the futures themselves is never fixed. It is based on the supply and demand estimated by the buyers and sellers about what commodities will be worth at any given point of time. In the world of commodities, speculator is crucial because it keeps the market moving and liquid. And you can go long or go short. It depends on what you want. You can buy and hold it for a long time, or you can just sell it in a short period of time. And to avoid getting wiped out, you must put a stop loss stop order.
And I think, in terms of the world economic, I think China and India could be big in terms of the commodity itself. Why? The first one, because for the China itself, we can see the population, which is a big population means a big customer. So there will be a high consumption in the commodities from China, and so did with the India.
Okay, guys. Generally, I already get from your information that already explained, and but to more in detail, can you explain to me in detail from each commodity?
Heavy metal commodity, lead. Lead is the most precious commodity, one of the first metal utilized. It has been branded as Persian's killer since the beginning of the history. It's not a popular business in which to be. So among others, lead prices are likely to rise. It's normally widely utilized as paint and gasoline addition. It is banned due to health and environmental issues. The supply of lead is going down. Lead production in the US has been down in the past 4 years. The production worldwide was down by 4% in 2001 and another 1.2% in 2002. The largest lead mine in Australia is the only new lead mine in decades and has been expanding capacity gradually since startup. In general, lead supply are down worldwide. The demand has disappeared from many products due to environmental restriction, such as from paint, gasoline, etc. However, it is an essential component for battery. Computer, telecommunication network also use lead as part of their raw material. In summary, the demand of lead is increasing. The price of lead is hardly going along with the ride with other materials. Decrease in supply and increase in demand leads to scarcity. By 2001, lead prices were $935 per ton. The high price of lead in today's global market, however, is a response to real supply tightening in period of increased demand, and it still moved higher as the demand increased. So even though the lead industry has lost two of its largest market in the last 2 decades, lead prices are making all-time high. It's a perfect example of how there can be a bull market even when the demand decreases. The lesson learned is decreased demand or slowdown of economic growth does not necessarily mean a bear market, not if supply are decreasing faster.
So let's talk about oil. Given the critical role played by crude oil, events in the oil market have a major impact in our overall economy. Over the past 50 years, oil prices have moved in a wide range, but it lacked any meaningful trend. Why is that? Because oil is heavily impacted by the supply and demand. For example, in the 1970s, Egyptian and Syrian attacked Israel positions on the eastern bank of Suez Canal. With the war still underway, the Nixon administration announces a $2.2 billion military aid package to Israel. And Arab responded by suspending oil shipments to nations supportive of Israel. The embargo reduces trade oil supply by 14% internationally, and gasoline price in the United States increased as much as 40% within a few months. Consumers in Europe, Japan, and the United States began to panic over oil shortage. On the other hand, oil price peaked in the 1980s at $39 a barrel, and then steadily declined for almost 20 years until it bottomed in 1998 at $11 a barrel. As a result, oil companies cut back on their capital budgets and oil rig counts and drilling activities. Eventually, the oil prices kept rising until 130 barrels in July 2008. So what does this mean? It means that in order to be a good investors, you need to understand the supply and demand of the commodities you're buying into. You need to understand how economies around the world is interconnected with each other. For example, as China's economy grew, the consumption of oil has more than doubled. This voracious demand for oil makes China the decisive player in international oil markets. When China is thirsty, the price will go up, and when China hiccups, so will the oil market. So in addition to economy, you also need to understand the politics of the countries, especially countries that are at the mercy of OPEC or Russian countries. But in the future, you also need to take into account alternatives to oil, such as solar power, wind power, bioenergy, because the alternative to oil might lead to a decrease in demand and will affect the price. So what I'm trying to say is that there's no single answer for why the oil price goes up and down. You need to understand that there are many variables that takes into account: politics, economies, even technology.
Oil may be the commodity that dominates the news, but no other asset has the mystic and popular appeal of gold. I will explain a bit about it now. It has been this way since the beginning of time. The ancients valued gold for its rarity, durability, and ornamental appeal. The Egyptians mined gold before 2000 BC. In 1960s, gold was $35 an ounce, and in 1980 it already hit $850. Gold inventories are the highest they've been in history of the world. Unlike most other commodities that used up, gold is virtually indestructible. All the gold that has been mined is still out there in one form or another. Gold has become a bit like an aging movie star. The glamour is still there, but there's not much work as there used to be. These days, industry and dentistry are the biggest consumer of gold. In computer, for example, the fine, thinner than human hair wire that connects the circuits to the semiconductors are made of gold. Each component's key strikes gold circuits that relay data to the machine's microprocessor. The gold standard for gold prices among the gold bugs and other gold hopeful was that 1980 historic high of $850. It is not a price we're likely to see soon outside an economic collapse so awful that we will all fighting one another to buy gold. But no wise investor should buy gold only in anticipation for another apocalypse. People should own some, perhaps as an insurance policy, as many around the world do. The world might panic and turn to gold as a desperate last resort. In the meantime, there are too many other more attractive opportunities in the commodities arena. Lead, for example, is at its all-time high and has been outperforming gold.
But as a coffee lover, I would like to recommend you to invest in a coffee. Coffee is the second most traded commodity after the crude oil. There are two types of coffee, Arabica and Robusta. Years ago, business practice has been awful for coffee producers because the coffee farmers were paid at low price while the end customers just like us had to pay our coffee at high price. But the current trend in supply and demand of coffee indicate that coffee has the potential to play its part in the bull market of commodities. The bull market is the condition of financial market or securities in which prices are rising or expected to increase. On the supply side, the production grew significantly with Brazil as the biggest producers. While on the demand side, the ICO or International Coffee Organization stated that the demand of the coffee was and will keep on increasing. So, seeing this indicator, I would like to recommend you to invest in a coffee because there's a potential market on it.
Sugar is one of the good commodities in the future, produced primarily in the Europe, USA, China, and Japan. According to the 2004 CRP Commodity Yearbook, the production trend has been moving more towards sugarcane, which does not seem to be as responsive to price movement as beets, since it is a perennial plant with a longer production cycle. For the past 20 years, however, the most significant change in the global sugar market has been the shift in the center of the production from northern to southern hemisphere, passing to the major continents Cuba, the USA, and Europe. Now are the Brazil, fellow Southern Australia, Southern Africa, Zimbabwe, and Switzerland. Before it has reached the sugar stadium, the Brazilians grew sugar mainly for the domestic consumption and for the ethanol, the gasoline substitute. So now talking about the sugar pass up and also the down. The price of commodity usually moves a good reason, and the savvy commodity investor must be familiar with the past trend and heavy in the ear out with the new ones, along with the places, fundamental change, and everything else that might affect the price of the sugar. And between 1966 and November 1974, sugar made the astonishing climb from the 1.4 cent to the 66.5 cent. And during those the year, sugar season began with extremely tight supply condition would rise, demand continued to rise. So now talking about supply and demand. Supply is the Brazil has the 8.4% share of the world market in sugar. During 1984 and 2003, Brazil production has increased in 144%, but with that increasing come after 1993 until 1994. Global sugar production increased in 35.4 million metric tons between the 1986 until 1987 and the 2002 and 2003 season average of the 2.2 million tons a year. So I think this one is very hikes for increasing 2.1% annual increasing. So the Brazil certainly had to pledge the sugar sale after the record from the 2002 and 2003 and almost in March of the 2003 and 2004 season. Production in Australia, China, India, Mexico, Thailand, and also the USA was also up due to the large parts to favorable weather. So that's why investor and analysis saw real promise in the sugar market. The last but not least about the demand. Demand increasing the following season and the might have the best supply in the three has been record sugar crop. Indian using sugar for ethanol, meanwhile China also the tech good game about to become the self-sufficient in sugar. In fact, China has been importing sugar increasing amount in the early 2000 importing 672,000 tons in 2013. The Chinese government announced that it will be importing more than 1.2 million tons in 2014. I think it's very used the importing from the sugar. So now the China's increasing demand also very good for the new sugar, already in the world third largest production for customer of sugar, mainly homegrown. The Chinese are developing the sweetened, which means more import and increasing demand. Okay, thank you for your explanation for the detail, and I think this is very interesting for me. and I will diversify my investment to those 5 commodities.
Okay, so how much are you willing to spend? We could probably help you in diversifying your options.
Don't worry, I want to take my money, my pocket. Okay,
Okay, Pak.
I think enough for you.
This one, guys.
That's all.
Pak, are you kidding us, Pak?
No, just waiting. Okay. What about this?
Come on, Pak.
Where are you going? Where are you going? Come on, please.
Our discussion today is based on a book written by Jim Rogers, Hot Commodities. In this book, Rogers offers the lowdown of the most lucrative market for today and tomorrow. The next bull market is here, not in stock or bonds, but in commodities. Investors diversify their investment in stocks, bonds, real estate, or maybe in the currencies. But commodities rarely hit the radar screen. In 1998, gliding under the radar, a bull market in commodities began. Less risky than stocks and less sluggish than bonds, commodities are where the money is and will be in the years ahead. Rogers' strategies are simple and straightforward. It's all about putting your money into stuff you understand. For example, the basic material of everyday life like coal, sugar, cotton, corn, or crude oil. Those are the commodities. In our opinion, this book is an eye-opener when the commodities market should be considered, because investment is not only about the stocks and bonds. But before stepping into this market, we have to understand the commodities utilization trend itself, which is talking about the supply and demand, and also about the timing and the momentum. The author, Jim Rogers, is an American businessman, chairman of Rogers Holding and Billion Interest Incorporation, co-founder of the Quantum Fund and Soros Fund Management, and also the creator of the Rogers International Commodities Index. When he was 5 years old, he started his own business of selling peanuts and picking up empty bottles left behind by fans at baseball games. He studied economics, philosophy, and politics at Oxford University. He is the author of several books, A Bull in China, Hot Commodities, Adventure Capitalist, and Investment Biker. He is known as contrarian. When the most of the investors just focus on the stocks, he chooses to invest in the commodities. The lesson learned is to invest in something that you know what it's all about. Don't just putting money here and putting money there. The smart investor look for opportunities to acquire the gain. And commodities can be considered as another portfolio for investment because value and strength of commodity is expected to increase in the future. But the key is to find the right momentum, and it's all about understanding the trend of supply and demand.
What is the problem? This is money. This is very big money. Come on, guys. Where are you going, guys?
Gue perlu yang supply and demand.
Cut. Come on, Pak.
This one, Pak.
Are you kidding me, Pak?
Okay. Please,
Cannot be, Pak. Cannot.
Belum.